Hi, this is Efrem Hoffman broadcasting live from NakedSwanTrading.com on Monday, June the 18th at just around 1:30 p.m. Eastern Time. What I'd like to touch on today are a couple of risk maps or price charts, and which will be defining the critical risk windows for the S&P 500 cash market and S&P 500 E-mini futures market based on the September contract as we progress through June into July and the summer months. I'd also like to comment on the risk disclaimer, which all of you must read before we actually progress on with this discussion. And pretty much you could read it in full by going to the website and clicking on Read Risk Disclaimer, or you could just read this section over here. It clearly indicates that the market research intelligence provided on this specific video briefing is for informational purposes only and should not be construed as investment advice of any kind, whether it is to buy and or sell securities today or in the future. So just please go through these details and then we'll continue. So without further ado, I'd like to first make a comment on this video box that you actually see on the left-hand side of our website. It's actually been posted on the site since May the 18th. And we issued a market crash warning at that time to tell investors that any market rallies that take place during the critical risk window that we see taking place for this summer months, as well as again into the in the fall or winter of 2012 and capitulating into May of 2013, what we really want to drive home is that there's this idea in the market that most people don't see. Okay, and at Naked Swan Trading, we'd like to get across that idea and reveal the secret. And what is that secret? Well, there's a thing called asymmetric risk in the market. It basically means that the risks are not equal on both the upside and the downside, even though for brief periods or extended periods it may look as if the market is trying to go one way, when in reality it is walking up a mountain where there's a cliff and an abyss waiting for you on the other side. And the key point to take home is that while the mountain that you're starting to climb, let's imagine you're up at a 10,000 foot elevation and you're climbing and everything seems nice and rosy and that the top is endless, and now you're, let's say, another 10,000 feet up and you think, wow, I just covered 10,000 feet of movement and things are really great. No sign of any risk. Well, the problem is our brains are wired into perceiving trends from experiences of the past. But in the market, to make money in the market, you really have to have a forward-looking vision of what is possible going forward based on the collective wisdom of traders that trade on different timescales and investors that buy and sell securities on different timelines. And to do that, you can't have a narrow view of the market, okay? And when you have a narrow view of the market, things may seem rosy just at the time where 10,000 feet of walking uphill may seem very insignificant if there's an abyss pointing down 30,000 plus feet into the water below. And if that happens to be the case, then that would be a situation where the risks are asymmetric. While the gain may have been substantial, on the other side of the cliff there was a potential loss that far exceeded the gain. And in the trading world, you really want to establish a reward risk structure where the asymmetry is in your favor. And that is what Naked Swan Trading is all about. So without further ado, I'm going to take you to one of the risk maps that we're going to be talking about today. And this happens to be a risk map of the S&P 500 cash market. Okay, on TradeStation, the symbol is $SPX.X. Okay, and I'm first going to talk about what standard technical analysis would tell you, and then I'm going to get into what our risk maps are telling us and why at Naked Swan Trading we are highly confident that any market retracements on the upside in this developing downtrend are nothing more than dead cat bounces with increasingly higher levels of asymmetric downside risks, meaning that the risks outweigh the rewards. Okay? Now, in normal technical analysis parlance, what people would do is they would look at the previous high point and look at where the lows were put in. And what happened here is the market rallied in to early May and then sold off. Okay, we gave our initial warnings on many market talks prior to the May period that there would be high risk of an asymmetric downside playing out in the early part of May and through May, and that's exactly what happened. And in technical analysis parlance, what happened is the market first made a pivot low. Then it came down on higher volume, which said that the volume it didn't dry up yet. Then the market retraced back into and actually just below the low of the previous pivot, which is pretty typical in a strong downtrend. And then the market retested the low. There was a very large volatility movement on the downside, but not a lot of follow-through. But if you take a look at the volume action, there was less volume on this drive down than there was on this drive down. So that was a sign that you could get a bounce. But the question is, with all traders, is how high and how long could that bounce last for? Now, there's another question traders should be posing, and it's not just about how high and how long. It's that no matter how high and how long that market grinds its way up or climbs a wall of worry, are the risks greater on the downside if new information such as negative reports were to come into the market and cause a surprise move? Would the surprise be bigger on the downside than it is on the upside? And if the answer is exceedingly yes, then you really want to take note and really de-lever your risk as the market actually retraces, okay, its movement. And what you will see over here is that most recently, and especially last evening, we had a classic situation. And I would call that a bull trap. Okay, so it's a trap that traps the bulls and where the bears are able to actually build some conviction around their overhead resistance levels. Now, when this market rallied up last evening on supposedly potentially good news, considering the Greek elections yesterday, what actually happened is that the market, as soon as the European markets opened, it was discounted and taken as a negative event, at least in the near term. And one thing traders know from experience is that when a market is rallying into an area of an expected good news event and then sells off on the news, that's a sign that people are perceiving the information as being potentially more bearish, and they're painting their vision of the future with a lower vision of bullish sentiment on a forward-looking basis, which basically means that even if more good news comes into the market, they could continue to discount it. The market is all about perception, and that is what Naked Swan Trading is all about. All of these lines that you see on the screen represent what the perceptions of different traders are on different time scales. And you can learn more about that on our website. If you go to the front home page of our website at nakedswantrading.com, on the left-hand side under the crash alert warning, what you will see is a Trader's World article. I just basically submitted that back in May, and it's available for all of you to view. And that'll give you a heads up of how this technology can be applied to the world of financial trading. Now, this rally that we just recently had, albeit rather large, but still small compared to the time that this market has spent coming down. And still, this rally has failed to get into the high of that low bar where the market did have follow-through down volume that was greater than the previous pivot. And that's one thing I think traders should focus on, that when a downtrend starts, and in Elliott wave theory you may want to call it wave 1. I don't use Elliott wave theory, but I'm aware of it. And if you want to call this wave 1, and then the market retraces, if it comes down on higher volume, okay, then you want to be always eyeing the high of the low bar that was penetrated with higher volume. Now when the market rallied up over here and came down, it came down on lighter volume than it had in this wave 3 down. Okay, that could be interpreted on a certain time frame in Elliott wave as a wave 3 down. Now because it had lighter volume coming down, there was less follow through and a sign that maybe the market wanted to do some kind of short-term bounce. It didn't have to, because when a market's in a strong downtrend, it could take on a life of its own. But you always want to be aware of what the key retracement levels and overhead resistance on the upside is, so that if in the event there is a short covering rally, you want to know where you could reinitiate a trade or de-lever risk if you happen to be a long-only trader. Okay? Or if you just happen to be a short-term trader participating in this up move and you want to then fade it again for the next leg down. Now, because this low over here had lighter volume, even though it had a larger downdraft, which makes it even worse. Lighter volume on a larger downdraft is saying that things are really drying up in the very near term. Okay? But the bigger picture in terms of what we see and what the asymmetric tail risks are far exceed any of these down moves that we've seen yet, and that is what we'll be talking about shortly. But because the volume was less on this down bar, we aren't not going to be calibrating the retracement to the high of this low bar. Because you can see here when the market rallied up, it went right through the high of that low bar like butter. But it did so because there was substantially lighter volume on this breakdown than there was in this down leg. So what we want to do is we want to calibrate the high of the low bar as the resistance level, as the overhead resistance level, based on the last time a pivot low was taken out on high volume. And it was done over here, so therefore the high of this low bar, which happens to be the area of 1363.50. So you can see here that the market rallied as high as 1346.59 on the cash market. It would have been substantially higher if the S&Ps didn't actually sell off as the European markets opened prior to the U.S. market opened. But that wasn't the case, and this market kind of sold off below that, the high of that low bar. Okay? Now, usually the market will fail somewhere between the high of that low bar and the low of that low bar. And that's exactly what it did. The low of that low bar was right around the area where it failed. So that area of 1347.75 to 1363.50 happens to be critical overhead resistance based on, analyzing price and volume behavior of the market. Okay? But we go beyond that. We go many steps beyond that at NakedSwanTrading.com. Okay? By trying to look at the market like a chessboard. A chessboard made up of all the traders from different time horizons, and seeing where there happens to be a confluence in the ways they perceive information. Because it's all about, hey, if good information comes into the market, but people collectively, or their collective wisdom and perception doesn't treat it as good information, then at the end of the day, as traders, we capitalize on opportunities based on the difference between what is actually out there in terms of news and how people react to that news. And money is never made by trying to forecast the news. It's made by understanding how people may react to upcoming news that is uncertain. And what this risk map is telling me right now, that there happens to be a confluence of activity. And it's been telling me since last week when we had our weekly update. I indicated on that update that this purple boundary over here, the market could climb a wall of worry along this purple boundary, as well as the upper part of this teal boundary acting as resistance. And that extends all the way out into July 25th. I'm not saying this market is going to have to continue crawling up into July 25th. What I'm trying to say is that we are in a critical risk window that if the market can't bust it up and is going to have incredible pains getting above that high of the low bar or this yellow boundary in confluence with this purple boundary and teal boundary, which happens to be in the 1347.75 to 1363.50 area, then if a market can't bust up, it consolidates, builds energy, and then busts down. And what's happening here, okay, is that as we build cause to go down over here, the downside risks initially are over 100 points lower to 1227 in the S&P, and then longer term over 200 points lower than the current levels. So that happens to be the downside tail risk, which is in the area starting out at 1170 to 1140 to 1120. Okay? Now, even though we have been climbing this wall of worry, this wall of worry doesn't have that much more on the upside that it could climb based on where all this resistance is. And even the distance between here and here is very tiny compared to the risk between where we are here and the cliff that we could be falling off of going into this area. And that is what I mean by asymmetric risk. The risks to the downside far exceed the risk to the upside. If this happened to be an inverted market scenario where the market was actually going down for an extended period and we thought that, hey, there was asymmetric risk to the upside, then short traders should take notice and understand that a short covering rally and an uptrend could develop. But in this case, it happens to be the opposite. We have been developing a downtrend. We are in a current market retracement, which has formidable resistance in the 47.75 to 1363.50 area. And we are looking for a heads up. And we're going to know that pretty quickly, because what you should be seeing is that any time the market tries to penetrate on the upside, even no matter how incrementally on the upside, as we go into the next few days along this critical risk window, what you should see is volume drying up, and drying up relative to these high bars here and drying up relative to the volume action inside the high of that low bar, okay, in the mid-May period, okay? And basically, what you're going to see here in the future, it shows over here 1332.25 to 1364.75 as long-term resistance, okay, as we progress into this risk window. The reason why I have 1332.25 listed here, even though the current market price is at 1345.43, you're wondering, well, how could this be overhead resistance if price is currently above it? It's because this is representing an area of potential resistance once the market starts breaking down on its first leg. Then the retracements, once we get underneath this teal boundary, the retracements will be limited by this teal boundary and this yellow boundary, so that if there is short covering rallies, then they'll be limited to climbing the wall of worry along these two boundaries in confluence, just as the market on this push down was climbing the wall of worry. But keep in mind that if the market starts breaking down here and the volume exceeds the previous low areas, it means that the retracements are going to be limited to the high of the low bar. And because the high of this low bar, and I usually combine the low bar with the previous bar if the low bar happened to be a very small bar compared to the previous bar. So basically, the next time the market rallies into somewhere between the low of this bar and the high of this bar, when the market takes out this low with higher volume than any one of this bar or this low bar, then basically we should see follow-through action, and all the rallies here should be dead cat bounces that take you down to that next major downside tail risk level. And these levels will, likely remain in effect for the remainder of the year. And then as the market penetrates those levels, we will then, focus on a video briefing that will discuss where the next major downside is, and the next major downside is not pretty. I could just let you know that it's only got 3 figures attached to it, and it's somewhere in the $700 to $800 range for the S&P. But let's talk about first things first, and as traders, let's focus on the near-term action. So I'm going to take you over now to a chart of the S&P 500 E-mini futures market, and where each bar represents 34 minutes, the trading range of 34 minutes as opposed to a daily bar. And you could see here that the market rallied up into the early morning of the 18th, sold off sharply as people started to perceive negativity, and the European market starting selling off in the morning, and as well as the EWP has also sold off. Okay, so basically, just bear with me here. One of my browsers just closed down on me. I had too many windows open. But anyways, that should be fine. So what you're seeing here on the S&P 500 E-mini chart is formidable resistance inside of that critical risk window, which happens to be in confluence with that risk window I showed you on the S&P cash market. Okay, just to keep in mind that the S&P September E-mini futures contract, the price levels are technically different. They range anywhere from 5 to 10 points difference based on where you are within a 3-month period leading into September. But currently, what you see on the screen here are the critical risk levels for the S&P cash, and they happen to be at the 1355.50 to 1363 area. And if we get that consolidation of energy building up in here, okay, what you will see is that the market when the market takes out 1325, with volume based on penetrating exceeding the volume of the down bar that occurred this morning, or whatever the down bar happens to be when the market decides to actually penetrate 1325, then you've got downside risk into 1302.50 to 1299.25 as a first line of support. I'm not saying it's going to bounce off of there, because most of these boundaries are sloped up, and upward sloping boundaries represent negativity from the perspective of this risk map. Okay, so if that was to happen, then the retracement should be limited to you're going to have some heavy resistance into the 1332.50 area. Okay, and still this whole area of overhead resistance remains as we push into July. The next level, when we take out the 1299.25 area and trade underneath there for more than 34 minutes, then the downside risk goes to 1267 to 1255. And just like I said on the daily chart of the S&P cash, if you take out a low point on high volume, then the retracements should be limited to the high of the low bar, or the previous, the low bar or the bar prior to the low bar when you take it out. And also, there's plenty of overhead resistance still inside of this window. So any dead cat bounces that occur after here will be limited, and then the market should continue lower, as indicated on the S&P daily chart. So the most dangerous thing for long-only investors, where bulls will get trapped in the market, is for the market to build cause, and if they can't bust them up from this level, because the volume keeps on getting lighter, the heads up will be market comes up, lighter volume, market comes down, builds more energy, consolidates longer, and we all know that when you get a longer consolidation with lighter volume as the market is climbing a wall of worry, and then the market breaks down on higher volume, then that's a heads up that the market is going into a wave structure on the wave down that has asymmetric risk, which means that the downside risks far exceed the upside potential. So that pretty much summarizes the bottom line for what I see unfolding going forward, and we look forward to having you listen to our critical weekly update next week on Monday. Thank you very much for attending this week's video briefing ending at 1:55 p.m. on June 18th, 2012.